Hi, my name is Alex Carlucci with Gustin Cho Associates at Loan Cabin. Here to talk to you today about residual income. A lot of you might have heard of it, don't understand it. It's actually very complicated. I'm going to do my best to explain it to you now. And it comes up in two spots. Let's start with FHA. If you're doing a manual underwrite, you have to have two of four of these things to go up to the 40/50 debt to income ratio. You have to have 3 months reserves in your bank account after you close. You have to have no payment shock from what you're currently paying on rent to what your new mortgage payment's going to be. You have to show maybe there's other income in the household, like husband's work, that we're not using that income, or you have overtime that we're not using because of overtime calculation rules, or you have to have residual income test. If you want to go 37 over 47, you only have to have one of those, and sometimes residual income is your lifesaver because you don't have any of the other three. That's one case you'll need to see it in FHA. And in VA, you're going to see it when you have very high DTI. Now, I've seen a desktop approval come in at 72% debt to income ratio on a VA loan. Problem is, there's no investors in the country that really go over 65, and we have 65 here. Most investors stop at 50, 55, 60. We go to 65. The problem with high DTI approved eligibles, you have to pass a residual income test. The residual income test is this. You have to take your gross income, subtract your income tax from the state and the federal government and the Social Security tax. Then you take away your mortgage payment. Then you take away all your monthly obligations like credit cards, car payments, student loans, the lowest minimum payment required on those. Then you take out your child care expenses, and that's a little kind of hard to explain how that works, but they know when you have child care expenses because you report it on your tax returns. There's ways for them to find out what your child care is. It's really babysitting cost. And then the final thing is you have to remove your utilities. And they don't know what your utilities are. They use a 0.14 times your square footage. And that number, let's say if it's 2,000 square feet, 0.14 would be $280 a month. And they would take that off of all that income. Once you're left with that last number, after subtracting all those numbers, you have to go to a chart. And I'm not going to go over the whole chart with you. But if you have a family of 4 and you live in Chicago, you have to have about $900. I'm gonna give you a rough. So let's say $1,003 for a family of 4 in Chicago for the residual income. So after you subtract all those numbers out of your gross income, you come up with, let's say you come up with $1,100. Well, you have enough money. You've passed the 1,003 requirement, so you pass the residual income test. That's it. There's no gray areas. It's just that's the calculation. This is the chart. So the smaller the family, the less the number. Let me give you an example. If you have a family of 1, it's just you and you're in Chicago, it's $441, so $441. So you have to pass that test to go over to get to high DTI VA loans, or for a compensating factor for FHA, you can use a residual income test. That's as simple as I can explain it to you. So if you like this video, please like it or comment below and we'll get back to you. And thank you very much.